If you get some sort of crisis and a flight into the dollar, which is what happened in 2008-9, people haven't got the gold to sell. They'll sell something else. So this is why I feel the downside in gold is very limited. And of course, the other thing is, and this is desperately important, it's not so much the gold price has been rising, but the dollar has been falling. And so much so that we've even seen this in the trade-weighted index. So in short, there is a lot of catching up to do. And I think it's all part and parcel of the swan song, if you like, of fiat currencies.
Silver nearly broke through the $40 mark on Wednesday, while gold futures looked ready for another breakout. But that momentum was cut short, allegedly due to intervention by what many consider the largest manipulator in the silver market. This kind of suppression, whether overt or covert, has long frustrated investors in precious metals. Despite that, analyst Alasdair Macleod believes silver is still cheap by historical standards. Gold, he says, is quietly building strength for its next move higher. In his view, fiat currencies are in their endgame. When the revaluation comes, it won't be gentle or gradual. It'll be sudden, aggressive, and will leave anyone waiting on the sidelines scrambling to catch up. A recent Goldbroker report adds another perspective. Total above-ground gold is now worth approximately $23 trillion, while the U.S. federal debt is approaching $36 trillion. If gold overtakes that number, it becomes the world's top homogeneous asset, unlike stocks or real estate, which are collections of diverse and often illiquid holdings. And we're closing in on that milestone. From a technical view, Macleod points out that gold has been consolidating in a tight range, forming a bullish pennant pattern. These patterns often resolve with a breakout, primarily when the macro backdrop supports it. There might be a temporary dip around the August options expiry, but the broader trend is solid. Adding to that bullish setup, U.S. real yields are expected to fall later this year as inflation stays elevated and the Fed pivots toward rate cuts. That combination makes treasuries less appealing and increases gold's appeal as a non-yielding asset. When real returns shrink, gold doesn't have to compete. It stands out as a safer store of value. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I mean, obviously, there's always volatility in prices of any commodity. But what I did was I thought I ought to have a look at metals prices in the context of the longer term, and particularly silver. Now, silver has been behaving as an industrial metal, and I've got, if you like, a basket of base metal prices going all the way back to 1900. And if you price that in gold, that is quite revealing. Bearing in mind that over reasonable periods of time, and I'm talking about decades, centuries, millennia even, the purchasing power of gold is relatively constant. I mean, the reason for this is that gold is accepted everywhere as money, and unlike Bitcoin, the supply increases, and it increases at a rate which, while it can vary, is more or less in line with the global population. So you have a stability, if you like, when you price anything in gold. And we certainly saw this up until the point where the Bretton Woods standard collapsed. The point is that if you take the prices at the beginning of the last century, so we're talking about over 127 years, you can see this stability in a basket of base metals priced in gold. But interestingly, recently, the value of these base metals priced in gold has actually declined quite significantly. And this year, it's standing at a roughly 77% discount to that 1990 level. Now, it always returned back to that level. Sometimes it'll go over, sometimes it'll undershoot, whatever. But what that indicates is that irrespective of what's happening to fiat currencies and their purchasing power, these base metals as a package, we can expect them over a period of time, we don't know how long, to increase roughly 3 to 4 times. Now, that is before you talk about the debasement effects of fiat currencies on metals prices. Now, this is very important. What it tells us in a nutshell is that base metals are more underpriced than they have been in the last 127 years. 25 years, sorry. This is really quite something. This has significant implications. We're not just talking about base metals, but if we're looking at other commodities, you're going to get a similar sort of message. And therefore, the implications for consumer prices, let's say on a 5 to 10 year view, is that they're likely to go considerably higher. So the rate of inflation, if you like, even though the government suppresses the numbers, will increase. But returning to silver, silver has been priced like one of these base metals, and there's nothing in it at all in terms of premium for its monetary role. But I think that is also going to return because gold is very, very underowned, and it's a racing certainty that as members of the public begin to catch up with what's gone on in gold, they will, at the margin, prefer to buy silver rather than gold on the basis that gold has already gone up and silver, has been left behind. So what we're looking at, in answer to your question, is silver is definitely on a tear and it's going to go considerably higher. And it's been doing it since I wrote that article, and I see this continuing. As far as gold is concerned, it's just been consolidating sideways. It's extraordinary how it's just moved sideways for the last, 2-3 months, consolidating and really providing a platform for the next rise up. In technical terms, we have what's called a pennant. Some would call it a triangle. And that triangle consists usually of about 5 legs. You go down, up, down, up, down. We're on the final down leg. And this actually coincides with option expiry for the August contract, which is on Monday. So I would expect to see gold drift off a little bit, but we're talking, 1-2% sort of thing. This is not. The other thing I would throw in is that this underpricing of metals as a whole is now leading to indigestion, if you like, in the papers markets. If you look at the best performing commodities this year so far, platinum, palladium, copper, silver, gold, it is extraordinary. And this is reflecting just how undervalued metals as a whole, precious or otherwise, have become. So anyone who thinks that there is going to be a decent reaction in gold and they're going to be able to get into it and all the rest of it, I think they're going to miss it, I'm afraid. And that's the way it is. It's very underowned. If you look at the other way of looking at this is this is gold, admittedly. It's estimated that total portfolio assets around the world, global assets, are in the region of, I think the 2023 figure was 270 trillion. If you look just at the ETFs, that represents less than 0.2% of that. I'm talking about global ETFs. Now, the reason I would say ETFs is that in most of the world, in terms of portfolios, you have got investment regulation, and gold is not a regulated investment. So it's actually quite difficult for an investment manager to put raw gold, physical gold, into a portfolio because he's got to argue the toss with his compliance officer. And do you want to do that? No, you don't. So what you do is you buy a gold substitute. That is why I think that the gold substitute in the form of ETFs, which is a regulated investment, is a fair indication of the level of gold interest in portfolios. If you get some sort of crisis and a flight into the dollar, which is what happened in 2008-9, people haven't got the gold to sell. They'll sell something else. This is why I feel the downside in gold is very limited.
Alasdair Macleod makes a sharp observation. It's not that prices are rising. It's that the currency is falling. When people finally understand that, he says, the game is over. The trust in the currency collapses. We're not there yet, but signs indicate we're moving closer. The US dollar dropped more than 7% in the first half of 2025, the steepest decline since 2006. That kind of move isn't just a blip, it reflects deeper concerns. According to the July 2025 Asian Development Outlook, the slide is raising questions about investor confidence in U.S. financial markets and the structural forces behind it. This week, the dollar is on track for its most significant weekly drop in a month. The decline comes ahead of upcoming tariff talks and major central bank meetings, with both the Fed and the Bank of Japan expected to leave rates unchanged. However, traders are watching closely, not for the rate decisions themselves, but for the accompanying messaging. Forward guidance from these meetings will shape expectations regarding future monetary easing or tightening. Sterling also weakened after UK retail sales disappointed, showing broader uncertainty in currency markets. Late Thursday, the dollar briefly recovered some ground against the euro after Donald Trump said he didn't plan to fire Fed Chair Jerome Powell, an offhand comment that still managed to move markets. That tells you how jittery investors are. Let's get back to the interview.
What you say is perfectly natural because you account in dollars and you pay your taxes in dollars. And so from the point of view of whether you're up or down, your risk-free position basically is cash dollars. But this is all an illusion because what you're looking at is credit. It is a credit risk, which depends on your faith in the Fed. And because it's a federal dollar, it's the Fed's dollar. And in turn, of course, the faith that you might have in the Fed is going to depend very much on the faith in the US government. Now, the reason that foreigners probably recognize this first and domestic users of the dollar recognize it last is obvious because foreigners, from their point of view, their risk-free position is their own currency. So, let's say, a Brit investing in dollars or whatever, he sees risk because he is accounting in sterling. He pays taxes in sterling. He makes his profits in sterling. You can see that foreigners are a lot more sensitive to what's going on, let's say, in a foreign currency than domestic users. Domestic users, they don't actually understand, the difference between money and credit, gold being money and the rest being credit. And the second thing is that they assume that all the price changes they see prices rising. They think it's not the dollar going down in terms of its purchasing power. They think it's items rising, for whatever reason. I mean, they call it inflation. Actually, inflation is a description of what happens to the quantity of credit. It's a complete misnomer when you're talking about what's actually happening to prices. Prices are rising, they're not inflating. Now, that's a different thing. The only way to look at it really is to understand the dollar's value in transactions is not a constant. It is something that is moving all the time. And for a long time, it's been moving downwards. I mean, if you look at it in terms of, going back to 1933, you had $20.67 to an ounce of gold. Now you've got $3,400 to an ounce of gold. Well, what does that tell you? Does it tell you gold's gone up? No, it tells you the dollar's gone down. And we've had a constant stream of crises ever since 1933. And first of all, there was the devaluation of the dollar. I mean, this is an interesting one because people would say, well, they rose the price of gold from 20.67 up to $35. Actually, what they did was they devalued the dollar by 40%. And then, of course, you had the Bretton Woods thing in 1971, driven off Bretton Woods. Nixon said he suspended it, to stop foreigners speculating and all this sort of garbage that politicians talk about when it comes to what they think is money. They were driven off it because basically what was happening is that as long as they fixed the dollar at 35 to the ounce, foreigners were just saying, well, here, you can have my dollars. I want the gold at that price. Thank you very much. From about 1947, 8, round about then, America had 22,000 tons of gold in its reserves. And by the time Bretton Woods was suspended, that went down to 9,000 tons. They were clearly running out. And, at the time, they were having to sort of sweep around, see what they could find left in the Fort Knox vaults. And, a lot of it probably wasn't actually deliverable into markets. So that's what happened. We've got, for example, in the UK, as late as 1935, the gold sovereign, was worth £1. Today, one sovereign is worth £600. Is it because the sovereign's gone up? No, it's because the pound is rubbish. It's gone down. So this is the message which everybody's got to understand. And this is why the last people who understand it are the people who sort of wake up to the fact that it's not prices going up, but it's the currency going down. And when people actually do understand that, when the general population understands that, the currency is doomed. We are not there yet, but we will go there. G7 nations, they've all got high debt to GDPs, and when interest rates rise, and they are rising, do not believe that they're falling. If they fall, they're being suppressed, and that kills the currency. You can see that which way this is going for all these currencies. It's almost like a race to the bottom, if you like. The thing about the dollar is that the dollar is the most important fiat currency. And there will come a time when the Dixie starts rallying for the very simple reason that everything else is falling faster than the dollar. That I think is going to happen. My own view on sterling is that sterling is in it's in a huge, great mess. Or more accurately, I'd say that government finances are in a horrendous mess. And so far, this has been ignored because where is the attention? The attention has been on, the wonderful President Trump and all his running around and upsetting things and all the rest of it, and trade and big, beautiful bills and so on. So, in terms of bad news, he's been stealing the limelight. That's going to shift. It will shift at some stage. I don't know when. I think it'll be terribly long. So the idea that the Dixie is going to go down and down and down and down is actually not the way to look at it. The dollar is going down and down and down against gold, not Dixie. I mean, I can see that Dixie falling to 90 from the current, 97.5, 8, something like that. That wouldn't surprise me at all. But in the grand scheme of things, that's not all that important. Some people argue that President Trump wants to see the dollar lower. I think he's talked about it. He certainly wants interest rates lower. And I think his attack on Jay Powell is actually very misguided. I think that's a very stupid thing to do. It's completely nonsensical. As indeed, from a foreign point of view, most of his trade policies are completely nonsensical as well. So, all other currencies are basically in the same boat. And we can see that the yields on longer JGBs are on the rise again. I think we're hitting new highs for 20 odd years or something on the yield on the 10-year JGB. And if you go longer, apparently there's absolutely no market in the 30 and 40-year-old maturities. What's going to trigger a new phase in this crisis? We just don't know. With everybody in the same sort of mess, greater or lesser degrees, it could come from anywhere.
Markets don't break from pressure. They bend until something snaps. What we're seeing isn't just volatility. It's a slow-motion fracture in the foundation. Currencies are losing credibility, precious metals are absorbing that vacuum, and investors are stuck between denial and scramble mode. The old playbook, trust the central bank, buy the dip, hold the bond, doesn't fit this new terrain. Real yields are eroding, technical setups are primed, and gold is no longer a contrarian bet. It's becoming a measure of monetary decay. Silver's stall near $40 isn't a ceiling, it's a warning flare. What happens when the market stops debating the timing of the reset and starts reacting as if it already began? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.